Welcome. My name's Gerald Stack and I'm a portfolio manager in the infrastructure portfolios at Magellan. Today I'm here with three of my fellow portfolio managers, Ofer Karliner, McVicar and David Costello. And we're going to talk to you today about the 2024 experience in infrastructure investment. We're going to talk a little bit about the types of things that we invest in, the sort of trends we've been seeing and the performance of the strategies over the year. Now let's start with how we think about infrastructure. Infrastructure for us comprises essentially 140 companies in two major sectors: regulated utilities, which accounts for about 60% of our universe, and about 40% in transport infrastructure. Transport infrastructure being assets involved in the transport of people, data and goods. These are companies that provide essential services that are essential for the efficient functioning of communities and face very reliable demand over time. Our own portfolio today is roughly a little over 50% in transport infrastructure and a little bit over 45% in utilities. We're at 3% in cash. So slightly different to our universe, slightly overweight transport infrastructure, slightly underweight utilities, but broadly significant positions in both major sectors and roughly equal holdings. There are three major factors, secular factors, that have affected performance over the course of the year. The rise in real interest rates, really over the last couple of years, the rise of commodity prices and energy prices, and the return to normal life really in commerce and post the pandemic. So those three factors have had different effects on the performance of the fund over the course of the year. Firstly, let's deal with real interest rates. Interest rates and monetary conditions broadly have been tight over the last couple of years. And those elevated real interest rates, that is the inflation adjusted interest rate, have had a negative impact on broad performance of infrastructure categories. So high real interest rates have come with inflation. Now inflation is beneficial for infrastructure strategies generally. It means that income which is linked to inflation grows over time. But the interest rate has been more than offset inflation over the course of the period. Inflation has been high. That's been beneficial for income streams out of infrastructure whose revenues and earnings are typically linked to inflation. But that factor has been more than offset by the rise in interest rates over the period, which had a negative impact on total value over the time. As a result, we've seen infrastructure sectors generally perform pretty poorly in terms of underlying investment performance through the course of the last 12 months, indeed over the last 2 years. So the rise in real interest rates has not been a positive. The second factor that's been important to us has been the rise in commodity prices and energy prices in particular. We've seen oil prices be elevated really over the last 2 years. And that for us is important because we exclude those assets whose earnings are directly linked to the oil price. Now, in periods where the oil price is rising as it has over the last 2 years, that means that for companies whose earnings are linked to the oil price, their earnings will rise, their share price performance is likely to perform pretty strongly. But as we don't invest in those sectors, we exclude those sectors because we see that their earnings are not reliable over the long term. They will be volatile in line with the volatility of the oil price. Because we avoid those sectors, it's meant that we've missed out on the contribution from those assets. So that's been a negative factor relative to the benchmark over the last year. However, if we take a broader lens to that and think about what we've done over the last 15 or so years, we've seen that while last year, or the last 2 years indeed, that oil prices were high, we've certainly seen periods over that time where the oil price has been low, if not falling. And in those periods we've done very well. And as a net over the 15 years, we've outperformed the index, which shows that there are short-term swings, there are also short-term roundabouts here. And in the long run, we believe very strongly in our approach. So interest rates have been high, oil prices have been high. The third factor that's been important to us over the last year has been the return to normal commerce post the pandemic. This has had a big impact on those transport infrastructure assets that rely upon volumes of traffic on roads, of passengers through airports. Indeed, let's talk a little bit about airports. Ofer, tell us about airports through the last year.
Yeah, one of the key themes we've seen is the continued recovery from COVID. You would have heard myself or one of the team speak at length this, because it's a rather large issue for the past few years. But really, it's continued to come back the way we expect it to come back, insofar as leisure travel, low-cost travel, short-haul travel have all been really strong. And that's played really well into a couple of key holdings like AENA and Vinci. And that strength has been despite the fact capacity hasn't come back as quickly as we would have anticipated. That's really a reflection of issues at Boeing and Airbus in particular. And Boeing has had major production issues stemming from safety concerns. Initially from the MAX crashes a few years ago, but then had a door blow out of one of their planes in January. To put the scale of the slowdown in context, prior to the crashes, they were producing 52 MAXs a month, delivering them. They delivered 19 last month. So, very material slowdown in capacity from them. Airbus has a slightly different issue. They used Pratt & Whitney engines. Those engines had a problem with pollution in the fan blades, metal used in the fan blades. You had a large number of A320neos taken out of service for maintenance. That's had a knock-on effect to production as well, because there's less components being manufactured that can go into new planes. So that's been a headwind to growth. Notwithstanding that, companies like AENA have seen traffic year to date up about over 11% against 2019 levels, about 8% versus last year. Again, facing their biggest customer, which is Ryanair, had to cut capacity and cut routes because they haven't got the planes they're expecting to get. But Spain really hasn't faced those problems. They've cut them from other regions. And that really speaks to the strength of Spain as a low-cost destination in Europe. So they've cut other destinations, but not Spain. So, AENA's done particularly well through this period. Looking forward, I probably expect growth to moderate next year. We've had an extraordinary period of growth recovering from COVID. We expect some normalisation of that, notwithstanding some capacity coming back into the market. But one of the things people probably not appreciating for companies like AENA is AENA's had its tariffs frozen since listing in 2015. Those freezes come off next year. Yep. So from 2026, they can raise tariffs again. So the basic tariffs have fallen in real terms by about a third to the end of last year. So all of a sudden you have the opportunity to start raising tariffs again. That's going to provide another leg of growth for AENA, which would help really crystallise some of the value we see in that stock. And I think really people are thinking about that at the moment. We'll get line of sight on that as discussions start next year. More broadly across the airport sector, we're seeing some risks from geopolitics. You always see those risks. Yep. Probably AENA was a bit of a beneficiary from the war in the Middle East, insofar as capacity is drawn out of that market and redistributed to other low-cost destinations or warm destinations in Europe and Asia. To the extent we see peace in the Middle East between Israel and Hamas, you might see some correction of that, but it wouldn't be swift. The flip side is if Israel gets into a major war with Hezbollah, and Hezbollah's now threatened Cyprus as well and become a regional conflict, we see more capacity drawn out of those markets, probably push more back into southern Europe. Ultimately, though, it's probably at the margin. Outside of escalation of the Ukraine war beyond Ukraine's borders, there's not a lot that's really going to knock about these things from a geopolitical point of view in Europe at the moment that we see. So we're pretty confident in the outlook for AENA going forward. Okay, so that's airports. Ben, let's talk a bit about toll roads.
Yeah, sure. I mean, a few of those sort of geo and especially the political bit plays into the toll roads as well. Maybe I'll step back for a second. So the toll roads we invest in, particularly in the European market, two companies, Vinci and Ferrovial. The interesting point about those two businesses is that they, whilst both being domiciled in Europe, they could not be more different in terms of end exposures. The reason we like both of these businesses is consistent with all the reason we like all of these toll roads is they're monopoly or near monopoly type assets. You get very high cash flow generation from these businesses. Toll roads cost very little to run once they're established. And you can generally increase your prices by something like inflation or more in a typical year. So I'll start with Vinci and what we're seeing there, because Vinci is a French or predominantly French business. Its most important assets are the motorways in France. Those motorways are interesting because they're very mature businesses. They're probably, let's call it, they have a decade left to run on their concession lives. Yeah. Those motorways, because they're mature, are generating an enormous amount of free cash flow. And so if anything, management's job at that company at the moment is to actually find a profitable home for that capital as that surplus continues to build. But notwithstanding what we consider to be pretty healthy underlying fundamentals, the share price has been impacted in the last year, in the last few months in particular. The biggest driver of that has really been the French political situation. Most people have probably seen how in France we've had Macron call a snap election. The concern for investors is that the current leading party, RN, they've previously talked about policies, helpful policies like nationalising motorways. The interesting point there is that looks like it's, from our perspective, to be reasonably unlikely to happen. When we look at actually the situation, one is the commentary from the party is already starting to back away from that a bit. The expectations are it could cost something like 40 to 50 billion euros to nationalise the roads, a very tough situation for a country already under strain from a fiscal point of view. And then the other point we look at as well is that the contractual protections in France are very good. You've got a mature set of contracts, they've been tested multiple times. So from our perspective, it's unlikely to be a risk. You know, we don't look lightly upon any of these political situations, but we think the risk is definitely lower than the current share price reflects. So that's Vinci. The other one we have in the portfolio is Ferrovial. As I said, it's a very different end exposure. Ultimately, Ferrovial is, whilst it's domiciled in Europe, it's predominantly a United States or a North American business, I should say, and it's had a great year. It's all just the share price has been reflecting the fundamental drivers in that business. One is they've got a stake in London Heathrow Airport. They sold that down for a price that, frankly, was well in excess of what we thought that asset was worth, and I think, frankly, more than what the market probably thought that was worth. You've had very strong performance out of the United States roads. And then, really importantly, they've got a sort of a crown jewel asset, the 407 ETR motorway in Toronto, Canada. They resumed toll price increases for the first time since the pandemic this year, back in February. And so they've increased tolls by double digits, sort of a catch-up amount. And that's buoyed investors as they've seen the ability of that road and the population that absorbed those price increases. So that's all performed well. And then perhaps we pass to Ofer to talk about Transurban as well.
The Transurban is an interesting one. From an operational point of view, it's had a good year. Traffic's been pretty much in line, some minor variances across different markets, but overall, operationally, it's done what we expected it to do. Share price performance hasn't probably been as strong as we would have anticipated. I think it's a reflection of real rates, as you touched on earlier. There's also the emergence of some political risk there. I think that's probably overdone to a fair degree. So we saw New South Wales do a toll review, or an asset toll review. We saw the draft report come out, or interim report come out in March. Importantly, Alan Fels, who's running the review process, has confirmed we have to respect the contracts. The government has said we have to respect the contracts. So Transurban is not going to be worse off the back of this. So most likelihood, you're not going to see major impacts. If you do, Transurban should be neutral or better off as a result, because they don't have to agree to anything. So I think it's a bit of a storm in a teacup. It adds a little bit of risk, but it's minimal, really. The other thing we saw is the ACCC for the first time reject a takeover bid or application for a toll road. So Transurban approached the ACCC not knowing the size of the Connect East stake that was going to be for sale. Initially it was supposed to be a controlling stake, that then got wound back, and the ACCC rejected it. Now, the theory, the logic they used was novel. It may prevent a future emergence of a competitor at some point. And that doesn't seem that sound. It hasn't been tested in court, and Transurban said they had advice that they had a pretty good case to fight it. Ultimately, a controlling stake never came to market for Connect East anyway, so it never got to find out. But it's not positive, but I don't think it's a major hurdle anyway. The next major asset coming up in Victoria is probably the North East Link, which is the government is building. It's 23 billion, I think, is the latest estimate for construction costs there. Connect East is a much smaller road regardless. It's still got a fractured shareholder base. It's not likely to be a major competitor for Transurban in that process. The same competitors that you got for the other processes will still be there, the Vinci's, etc. We'll probably have a look at it then, but we don't see that as a major risk. On the flip side, what we're seeing is some of the option value starting to materialise and come closer. So we saw the M7 widening get approved last year. That adds a bit of value to Transurban. And remember, toll roads generally, because you're the guy who runs the road, no one else can really widen the road or do other works associated with it, have inherent option value in there. The management's job, part of the management's job, is to unlock that option value. But things like Queensland is widenings that need to be done on a number of the roads there. We've got the Olympics in 2032. There's kind of a clock ticking for the government to try and get these traffic problems fixed. So we think there's probably a near-term catalyst there for Queensland in terms of realising some of that option value. We've seen in Virginia the government looking at reversing or making the I-95 bi-directional tolling. At the moment, its title goes into Washington in the morning, out of Washington in the afternoon. That creates additional value, potentially extending the Capital Beltway south as well. That adds value as well. There's a bunch of little projects that all incrementally add value that aren't captured in the share price as well. So And ultimately, the stock price performance hasn't done fantastically well, but the underlying fundamentals are still very strong for Transurban.
Yeah, look, a portfolio of a huge number of projects, all incrementally adding value. It's kind of a nice cocktail. So we've talked a bit about the major infrastructure, transport infrastructure sectors, toll roads and airports. Next big to talk about is utilities. Dave, do you want to talk a little bit about US utilities?
Yeah, certainly, Gerald. The US utilities in the portfolio have continued to deliver remarkably robust fundamental underlying results. Almost without exception, they've continued to deliver results in line with management's guidance for 5 to 8% underlying growth in earnings per share. And their robust outlook continues to be underpinned by a series of secular tailwinds that ought to sustain that growth over a multi-decade horizon. You know, the continued connection of new renewable generating resources, for instance, the replacement of ageing grid infrastructure, and in time, the augmentation of networks to support the partial electrification of industry, transportation and buildings. But over the last 12 months, Gerald, we've started to see the emergence of a new secular tailwind that supplements and reinforces that constructive outlook. And that's really been around the re-emergence of electric load growth in the US. And this factor's come on with surprising force and rapidity. It's surprised everyone. For the last 20 years or so, we've seen virtually no electric demand growth in the US. But increasingly, our utilities are pointing to expectations of quite meaningful load growth going forward. So Dominion, for instance, one of the holdings in the Magellan infrastructure strategies, has recently almost doubled its expectation for load growth over the period to 2029. In their 2020 plan, they saw projections of maybe 1.8% per annum load growth. In their 2023 plan, that almost doubled to 3.4% per annum. And we've seen that increasing outlook replicated to a greater or lesser extent across the whole sector. So Georgia Power, for instance, a subsidiary of Southern, who we hold in the core infrastructure strategies, in their 2022 integrated resource plan, where they project demand on their network and the resources required to fulfill that demand, they projected something like 400 megawatts of incremental demand over the period to 2031. So very little growth in the context of their system. Just 18 months later, they had to revise their integrated resource plan, now projecting 6.6 gigawatts of demand over that period, a 17-fold increase in just 18 months. And when you look at what's driving that rapid escalation in load growth, it's really attributable to three factors. Probably the most prominent of those has been the rapid expansion of data centres to accommodate exponential growth in artificial intelligence workloads. That's been a really significant driver, and I think it's reasonably well understood. The second and third points, though, are perhaps more subtle. The second point has really been around the reindustrialisation of the US economy, partially in response to incentives under the Inflation Reduction Act, but also, I think, partially a product of the US seeking to decouple from its major strategic rival in China and bring back some of those capabilities to the US. The final factor that's driven this load growth is a little bit paradoxical. It's really been driven by the resurgent oil and gas industry in the US seeking to improve their ESG credentials by electrifying their compression stations in the Permian Basin. And that's been significant. So, there's certainly suggestions in the market that this will materially enhance the growth prospects of the US utilities. We're a little bit more circumspect on that. We think growth's likely to be sustained at about current levels. But this emergence of load growth does two important things that improve the outlook in our view. Firstly, it extends and reinforces this already very constructive capital investment outlook that underpins our investment thesis for the utilities. So that becomes more certain. But secondly, and perhaps even more subtly, by amortising network infrastructure costs over a broader demand base, it also serves to reduce pressure on customer bills. So it enables the utilities to deliver this infrastructure build out in a more affordable fashion for consumers and therefore makes it more reliable.
Okay, so load growth equals capital opportunity, which ultimately means earnings growth for these companies. Exactly. We're seeing similar things in Europe?
Yeah, so in the European market, I might actually split up what we do into a couple of different buckets in the European space. So one is the electric side, where we've got some investments, and particularly in Europe, the opportunity set is more about the high voltage transmission lines. As well as in the European market, we have some exposures into the gas sector. And that's an interesting opportunity for another reason. So these companies, just for context, are very much in keeping with the way we think about the world. These are regulated monopoly businesses. Their whole economic model is you get paid on the amount of invested capital in the business and an agreed return on that capital, so very secure businesses. What is happening though across those two buckets of electric and gas? The electric side is very similar, but one of the underpinning contexts here is around the European Union's very ambitious climate and decarbonisation goals. So the European Commission has put out targets where effectively they want to see renewable energy represent about sort of at minimum 42.5% of total consumption in the market. That's up significantly from recent years where they hit about 23%. So you can see a near doubling of the level that they want to do. In addition to that, in that market, what they're talking about is really rapid penetration of electric vehicles. And so what they want to do is they have an ambition to have no new combustion engines sold for vehicles by 2035. We'll see how that plays, but that's sort of the direction of play here. So what we can see is there's very strong underpinning drivers that are taking you in that direction of investment in the electric grid to support that kind of ambition. I think the easiest way to really demonstrate this is just an example. So the company that we've got in the portfolio, Turner, they operate the Italian transmission grid. Back in March, they put out their capital plan for 2024 to 2028. That's a bring forward of their most recent capital plan. What they've said is that they are going to invest 16.5 billion euro in capital expenditure over that period. Now that, for context, is up 65% since they last came out with a plan of 10 billion a few years ago. So it gives you a sense of what they're doing. So what's happening here? Well, it's resiliency of the grid, digitisation of the grid, but as importantly, they've got a number of projects which are really targeted at connecting and effectively creating backhaul to connect the renewable opportunity in the south of Italy to the load centres and industrial centres in the north of Italy, where most of the population and economic activity is. And so it gives you a sense of what's happening there. We're seeing similar stuff in Spain, where we've got some investments as well. Now, that's the electric side. Now, as you might imagine from this, though, the gas side is very different. Gas is about, I think, the market's concern that gas has no future in the European market. And I think that's very far from the reality that we're sort of seeing on the ground. When we look at a couple of companies in that space, we've got two investments in companies, Italgas and Snam, both operate out of Italy in gas transmission and distribution. In both instances, what we see is they are trading with a very strong valuation opportunity. You can get dividend yields in these companies of north of 7% per annum. That yield is secure and growing, typically by at least inflation each year. So really attractive valuation opportunity. So why aren't we worried about the risk that is potentially looming? Now, in the near term, there's a lot of barriers to decarbonising gas. When you think about the central use for gas in most of the Italian market, it's really about providing heating loads. And what that does, it's really hard to electrify for the near term, is effectively gas provides you an ability to create a giant battery. During the warmer months, you fill up the reservoirs, and then during the winter months, you can draw down on that. And you look at the way that plays out in practice is the amount of energy coming out of that gas network in the winter months far outstrips energy you can put on the electric network. And so not only is it difficult to electrify, nor is it efficient to electrify, because you would build a huge electric grid to then sit idle for the summer months. So it's not an effective use of capital. So that's in the near term, the barriers to doing that. And the longer term, the thing that gives us some confidence is all of these companies are looking for ways to provide efficient decarbonisation in the market. So take Snam, for example, they operate the big pipelines in the market. They are actually working really hard to create new opportunities around things like renewable natural gases, as well as, it's an industry in its infancy, but hydrogen as well. So they're looking to sort of understand how hydrogen can play a role in decarbonising the economy as well. So we see different ways and different opportunities in the market because of some of the themes we're talking about.
So we've talked a bit about both electric and gas utilities across our portfolio, across both North America and Europe. What about water? Dave, do you want to talk a little bit about in particularly UK water companies?
Yeah, certainly. Of course, we've progressively built stakes in two UK water utilities over the course of the years, Severn Trent and United Utilities. And we added to those positions as we saw weakness in their stock prices emerge, driven by what we regarded as transitory overhangs. It's an election year in the UK, that always breeds uncertainty, but we thought that was overdone. It's a year for a draft and final determination for the next 5-year regulatory period in the UK. But perhaps most prominent as an overhang on the performance in the market of Severn Trent and United Utilities in our assessment was the potential failure of Thames Water, one of their unlisted peers, and concerns that that would result in contagion that impacted Severn Trent and United Utilities. And that overhang saw Severn Trent and United Utilities at various points of the year, their enterprise value declined to a level broadly commensurate with the book value of their regulatory assets. Now, these assets would customarily trade at a 10, 20, sometimes even 30% premium to the book value of their assets. So to see them trade at book value is exceedingly rare and something of an opportunity. Indeed, the last time we saw these assets trade at that level was in the run-up to the 2018 general election, when Jeremy Corbyn campaigned for Labor with a platform of renationalising these assets. And of course, the polls at the time in the lead up to this election suggested he was an even money chance to form government. So certainly a period with very dark clouds over the sector. But in asserting through valuations that nationalisation was likely here, a policy that the current Labor Party has expressly disavowed, or in seeking to draw parallels between Thames and United Utilities and Severn Trent, we thought the market was indiscriminately pricing risk. Severn Trent and United Utilities look absolutely nothing like Thames. Thames assets are geared to nearly 80%. The company's financially distressed. Severn Trent and United Utilities are prudently geared at around 60%, broadly in line with the regulator's assumed notional capital structure. Persistent regulatory penalties for poor operational performance has seen Thames deliver its shareholders a miserly real return on regulatory equity over the current 3 years of this regulatory period of about 1.9%, about half of their baseline return allowance. Compare Severn Trent and UU, who have delivered a return approximately twice the level of their baseline return allowance, about 8% per annum in real terms. Now, of course, they also get indexation to inflation, so in nominal terms, you're looking at a return in the teens. Extremely attractive for a low-risk business. And of course, the sector's environmental credentials have been in the headlines in the UK. Well, again here, Thames has a very checkered environmental track record. They've been fined significantly by the regulator and the Environment Agency, and in each of the last 2 years, they've achieved amongst the worst environmental performance assessment scores in the sector. Again, contrast Severn Trent and United Utilities, whose environmental credentials are unparalleled in the industry. Severn Trent is on track to achieve a record consecutive best-in-class 4-star EPA rating this year, and United Utilities has achieved that feat in 2 of the last 3 years. So while the market has marked down the stock price of Severn Trent and United Utilities, we'd observed that their fundamentals have actually improved as this period has gone on. And that assessment really rests on 2 key observations about their fundamental performance. The first is a rapidly improving expectation of sustained growth in the industry. Growth in the UK water industry has been pretty anemic for the last several regulatory periods, spanning 10 to 15 years. And in the last period actually turned negative for most companies in the sector in real terms. Contrast that with Severn Trent and United Utilities' business plans for the forthcoming regulatory period, which starts on the 1st of April next year. They're proposing real growth in their regulatory capital value of approximately 5.5% to 6.5% per annum. So in nominal terms, once you account for inflation, high single-digit rates approaching 10%. Now, this is only a business proposal. The regulator needs to approve this, but we've got a high degree of confidence that the regulator will approve the bulk of this investment because it's underpinned by a clear legislative mandate introduced during the current regulatory period, and the regulator has a statutory obligation to fund a company to meet those requirements. So a high degree of confidence that that will be funded. The second characteristic that enhances our confidence in the outlook for these businesses is capital market conditions. When the regulator issues its final determinations in December, they'll restrike the company's cost of capital allowance. And if we compare market parameters today to when Ofwat, the regulator, last struck their early view of the sector's WACC in September 2022, we find that the real yield on 20-year UK gilts, the benchmark reference that the regulator uses, are approximately 125 basis points higher. So that should pass through in a fairly mechanical fashion to the regulator's cost of capital allowance, which translates to increased earnings for the utilities. Now, we expect that the opportunity for value crystallisation from these stocks will be realised in the near term. We're expecting a draft determination from the regulator on the 11th of July, which we think will demonstrate to the market this improved growth prospects and the likelihood of a higher return over the next 5-year periods. So, having increased our stake in these companies at discounted valuations, we're confident at this point that this will yield extremely attractive forward-looking returns, with valuations on a relative basis arguably justifying multiples in the region of 1.3 or 1.35 times relative to the prevailing levels around 1 time. So a very constructive outlook in our opinion.
Yeah, so impressive businesses with a history of strong operating and financial results, with a really strong outlook and indeed improving outlook, albeit trading at really cheap prices by historical standards. Absolutely. Lot to like. So what we've done today is to talk a little bit about both our transport infrastructure and our utility parts of our portfolios, and hopefully we've given you the understanding that there's a lot to like here. These are strongly performing companies with a really positive outlook across the board. In addition to which, we believe we're going to see a normalisation of interest rate conditions from here on in. We think we've reached, broadly speaking, the peak of the cycle. So we'd expect interest rate impacts on these businesses in terms of the way these businesses are valued to normalise as we move forward. And as a result, we're really optimistic about the outlook for returns here. We think infrastructure is well placed. We expect infrastructure to deliver inflation +5 over time. And in that sort of environment that we're now entering into, we would expect the strong earnings power of these businesses to really be reflected in underlying investment performance. Hopefully you found that useful. Thanks for listening.